All right. Hello, everybody. Good morning. Zach and Megan here. We just wanted to give you like your monthly market update. So we hope you're doing awesome. If you are on the call, happy to see you. If you're watching it later, even better. Shoot us a text, call us, let us know what we got. So we wanted to just make this a quick update for you guys. Not too long, really just go over things. But if you guys do have questions, obviously this market's pretty rapidly changing. Just shoot us a text, call, email. We're happy to help you out in anything that we can. Meg, did you want to add anything to that?
No. If you guys have any questions, you can put it in the chat while we're going, and we'll be checking that.
Okay, so I'm gonna get this going. Meg, you'll have to just let me know once I got this up. Okay, sorry, just zoom in me. Okay. There we go. Can you see that? Is it working?
It takes a second. Okay, now we can.
Can you see that good?
Yep.
Okay, perfect. So like I said, you can see everything here then?
What did you say?
You can see this all pretty good?
Uh-huh. Yeah, it looks great.
Cool. So really the biggest thing, I wanted to talk about a couple of points in this, really just in a concise manner. So like I said, if you do have questions, please let us know. But the 4 topics that I wanted to really go over today were, one is the FHA big news that actually happened on Tuesday, pretty unexpected. They're going to drop their mortgage insurance premium. Not all the way, but they are going to reduce it, which is awesome. It'll be a really big benefit. The second is that we are going to talk about the increase in rates that we've seen over the past 6 weeks, really. Show some trends, kind of some updates of what we might see in the coming weeks. The third item was actually home builder sentiment, to kind of talk about if you are looking at some new construction, what's that going to look like? Which a lot of times that actually correlates into some even existing home sales, which I'm sure Meg will also touch on. And then also the last thing is some new loan level pricing adjustments, or some things that concern with interest rates that we can kind of help and save us some money eventually just by doing a couple simple steps. And then there's a couple other just minor things that we'll go over in regards to the market. But the biggest thing is I wanted to talk about, which is huge news for everyone, FHA dropping this mortgage insurance premium. So what happens is this actually goes into effect on March 20th. So really, they're still kind of figuring out the dates of this. For those existing customers with FHA loans, it's not going to change. But from those endorsed or going forward from March 20th and so after, they'll have these new reduced premiums. So you can see up here on this little graph that I put up here, just the difference in mortgage insurance. So what this does is actually drop the mortgage insurance about $100, just given the specific loan amount like we have right now. Why this is a big benefit though is FHA allows people to get into homes for 3.5% down and zero down in some instances, right? When you're doing like a down payment assistance program. But a lot of the conventional 3% down programs actually have income limits on them where the rates aren't as favorable as you get to these higher income amounts, whereas FHA doesn't have those. And so now it's even a better product for getting into homes for a little bit lower of a down payment with a more advantageous mortgage insurance premium. FHA loans will also allow you to qualify a little bit better for a better rate, even with a lower credit score, which is awesome. So typically on a conventional loan, you want to stay above a 700 if you can. Whereas on an FHA loan, you can really do them down to, we have loans that go down into the 640 range, 620 range, but you're not as dinged for the credit score. Great for first-time home buyers, great for people that might not have adequate credit, and great for people that are really struggling to get a bigger down payment. So just an awesome news, and really welcomed kind of in a market that I feel like we've had some just lackluster of news and rates kind of for the past 6 months. Any questions about that, Meg? Do you have anything that you wanted to add into that?
Yeah, so does it have to be your first home to get an FHA loan?
No, it does not, which is a great question. So FHA, the one thing that FHA does have is FHA, they have a 100-mile radius. So it's hard to have an FHA loan right now and then go into another FHA loan. So typically it's better to have like a conventional go into an FHA loan or something like that. But it is not just for first-time home buyers, which is great. So it can really be anybody that kind of falls in that threshold.
Perfect. Cool. I love it.
Awesome. I don't know. Is there any questions in the chat on that?
No, I don't see any.
Okay, perfect. Cool. So the other thing that I wanted to talk about and jump into is the increase in rates that we've seen. Over the past, I did this chart just on 30-year fixed. And granted, these aren't like perfect rates. These are just kind of a generic basic rate of what we've been seeing on since January. But you can see that we saw rates get pretty low there. Really the middle of, I mean, honestly, middle of January to the beginning of February, we saw some stuff even into the low or 5 range. They have started to tick up mainly because of some recent inflation data. And that does seem like that's kind of in some ways expected, as the year-over-year reading for that was actually a little bit higher than kind of estimates were. They have started to come back off their worst rates, which were about Tuesday and Wednesday, which is some welcome news. The other good thing is that we have another inflation report coming out on March 14th, which the year-over-year reading for this does poise to be favorable for rates. So obviously it's really hard to time the market. There's a lot of uncertainties that go along with inflation. But one thing is for certain that we can kind of know and expect that rates will start to trickle down as this inflation starts to get under wrap. And a big question that I get more than anything is, hey, like I heard that the federal funds are going to increase this rate, right? And that rate is not a direct correlation or an impact on mortgage rates. Although sometimes they go in correlation, sometimes they have an inverse relationship. So as it looks like the Fed is fighting inflation, it'll actually help interest rates, as we can see that those rates will become more of a safe haven or a better investment for some people. And so, like I said, it's impossible to time the market. It's impossible to know exactly where they are. But from what we can see and what we can see in the past of where these rates and inflations have kind of come in on these reports, March 14th should be welcome news all the way until about May, where these inflation readings on this year-over-year basis were pretty high, which should be awesome. I mean, great time to get into the house for the spring. Great time to see some lower rates as we kind of get into this year.
So right now rates are about 6.5.
Yeah, 6.5 is pretty like standard for where most people are at right now. Shorter year terms, 15, 20-year notes are going to be a little bit less than that. FHA is pretty close to that as well. So some of your zero down programs may be a little bit higher because the risk threshold is built into them. But again, I mean, they're all pretty standard within that range. So
cool. I know a question that I get a lot, and we talked about this a little bit yesterday, was how soon can someone lock their rate when they are looking?
Yeah, so let me skip up to that. We'll go back to that. So I really thought that was a great question. I know that we had kind of discussed that a little bit. So really it's important to know we can lock loans all the way up to a year in advance. Mainly those are like new construction options when people understand like, hey, like I'm going to be in this house, this new build may take a long time. Or it's 6 months from being built, but maybe the builder is a little bit less than consistent. So maybe we do a little bit longer of a period of time. These can be great options in an increasing rate environment. Like last year, I was telling Meg that earlier this week, we had a lot of new construction that actually locked last April that ended up closing in October, November of this year, which they were able to get some really high 4s, even low 5s range when that really wasn't available at the time. Most people lock typically on a house within 30 to 45 days out. If it's a really short contract, we can do a 15-day lock, which is usually a little bit more advantageous for the borrower just because the lock period is a little bit different. A new program that we do have though is a 90-day lock and shop. The program's not for everybody, right? If you kind of feel a lot of immense pressure to maybe go that route, that may not be the best option for you, but what it does allow you to do is as rates start to drop down. And if they do, then you do get the option to float down one time as long as it's within 30 days of closing, which can be a big benefit to you because if rates do drop, then you can kind of see a drop in your rate, but you're protected if rates do go up. I would say with locks, there's not a one fits all, right? Depending on the contract date. Some I know that like with length of time, sometimes it's a 60-day or 90-day, but these are all good options to look at. But I would say the most standard lock period is typically within a 30 to 45-day window.
And with that, they do have to have a contract in place in order to lock the rate,
so
unless you're doing the lock and shop.
Yep, exactly. So if you have to have a property address tied to that, if you're going to do any of those extended lock periods of time. The 90-day lock and shop, you do not have to. We just lock it as a to be determined. So once you do find an address, we'd go in and put that in. And like I said, that program may not be for everybody, depending on if you're really not certain of your time frame. But also at the same period of time, it is a very good likelihood that we'll see rates drop over the next coming months. And so maybe some of these long-term locks don't fit into what people are after, depending on what their timing looks like. So
Cool.
sorry, you guys get to see everything. So one thing really quickly is this home builder sentiment. I thought this was good. Really just a quick plug. The nation continues to face a sizable housing shortage. So housing shortage is where there's just not enough homes for people to move into. And as the sentiment came in higher than it has been the year over or the month over month reading since 2013, so about a 10-year difference in this reading. And what that builder sentiment essentially shows nationwide about how builders are feeling about what this upcoming year is going to be bringing. And I thought this interesting statistic that I plugged in here, builder incentives dropped 62%, or were about 62% in December to 57 in February. So you see that what this essentially is builders that were willing to do seller paid closing costs, right? Or 3-2-1 buy downs, 2-1 buy downs, covering HOA fees, things like that. They're starting to drop those incentives that they were giving out to people, which obviously it's only a 5% drop, but I think we'll continue to see that trend to where it was a couple of years ago, where you were even bidding over what the builder was willing to sell the home for. And a lot of times the same kind of pattern translates into existing homes, right? And so that can be something that you need to be aware of, as the builders are also realizing that the market will likely heat up in the coming months. And so they're starting to forecast that into not only their purchase prices, but in the concessions that they're willing to give back to consumers. And so there's still a lot of good options, but that is one thing to be mindful of, is nationwide builders are starting to have a little bit more confidence in the market, which is good for everybody. But at the same time, it will allow a little bit less of what you could get with some builders and translate over into some existing homes as well. So, and then the last topic that I wanted to really go over was these new rate adjustments. And so every time, everybody always asks how to get the best rate, how to do the very best thing. And so typically, and how it has been for the past, I don't know who knows how long, typically if you're above a 740 credit score, up to 850, your rate really remained the same, right? Things that would change that rate are bigger percentages of down payment, right? 5%, 10%, all the way up to about a 40% down payment is where you're going to get a certain rate adjustment. What's going to happen now is in May, they're reintroducing these new loan level pricing adjustments. And so now, instead of having just anybody above a 740 gets a certain rate, those are now going to be tiered all the way up to a 780 credit score. And so it's more important that you're getting your credit score up and higher so that you can get the very best rate available. So that will help people as you get your higher credit score. As you have a lower down payment, you're still going to get a good rate. But it's important that you realize, hey, like if I'm at a 777, what can I do to get me to a 780, right? If I'm at a 719, how can I get to a 720? And that's something that we're happy to look at, right? It's a timing thing. We need to make sure you have adequate lines of credit. We need to make sure you're paying things on time. And we can do things to help you improve your credit score. The other impact that goes into this as well is that they're also going to start factoring in your debt to income ratio, or the amount of money that you're putting towards your house payment and then all of the other debts. Right now, that has never really had an impact on the actual rate that you were getting. It had an impact on the mortgage insurance if you weren't putting 20% down. But that is going to change a little bit now, to where as long as you have certain debt to income ratios, the lower debt to income ratio they have, the better the rate will be. And so it's important to eliminate monthly payments if you can, or to try to get the minimum monthly payment on these cards or car payments or things like that down to help you to a better rate. So I think that's important, and it's good to know, because that simple decision can save you a lot of money.
That's so interesting. Well, and like fixing your credit takes a little bit of time, or even adjusting it. So even if you're not ready to buy something right away, this is something that, you should get in touch with Zach and really look at it now. And so you can get those 7 extra points so that when you're ready, you're not scrambling to get it done.
Right. And it's so imperative just to realize, hey, like just a couple simple tweaks, right? Paying it off a little bit sooner, making sure it's paid off when the next credit reporting comes out, and things like this that can really help save you thousands of dollars in the long run that may only take $10 to $15 just to pay the credit score off.
Yeah.
And so I think it's really important to realize, hey, like credit is going to be increasingly important as rates get up, because as rates get up, they're trying to mitigate some of the risk, and people with lower or higher credit scores pose less risk to lenders. And as a result of that, they're rewarding you for that better credit score, which is awesome.
That's really cool. I didn't know that was coming. Thanks for
Yeah,
sharing
so
that.
that's coming up in May. So I know some lenders have already started pricing that in. I believe that most lenders will have priced this in about a week before May, so that last week of April, as I think when that kind of comes in. And that's to all loans that are going to be serviced to Fannie Mae and Freddie Mac, which is a pretty big portion of all loans, pretty much any conventional loan that would go through that route. And I thought this was a really valuable statistic that our marketing department put out. I still get a lot of questions about this all the time, right? How is this market different than 2008? Kind of what's going on? What's been the biggest things? And I thought this graphic did such an amazing way. If you want to take this, screenshot it, send it to your neighbor, your dad, whoever it is, right? I think this is information that's very, very valuable to show kind of why this market is so much different than it was in 2008. One being that I love, the subprime loans were very, very prevalent in that time back in 2008, which virtually it's pretty much really hard to get a loan now, right? I mean, if anybody that's done a loan in the past 12 years has done one, they realize it's a lot of different process. And I thought this other thing that was pretty substantial and pretty awesome was this inventory on the market. Our population is increasing so rapidly, but to see that there's still such a shortage of homes on the market, despite more people going back to work, more people out there in the market, that inventory is such a tight level. And as long as that level remains tight, home prices will continue to stabilize or go up. And so that's why I think we're seeing, and I know Meg will probably touch on this, but it's so important to realize, look, there's a lot less homes on the market and a lot more people trying to get into the market. And then obviously you have these pretty important, significant mortgage delinquency and homes in foreclosure, you can see are quite a bit different than they have been in the past, which I think is super important to realize, hey, we're in a completely different market. And so if we think that the market's going to crash, it's really at this point, obviously, we never know what's going to happen. COVID 2.0, I'd hate to say it, but things are crazy, right? But at the same time, it's realizing, hey, let's take a step back and look at the statistics of why this market might be a little bit different. So I think that's awesome.
Love it. Thank you.
Yeah, you bet.
So
Any question? Anybody got any questions? We got anything in the chat? I didn't even look.
We don't have anything in the chat.
Okay, sweet.
Okay, I will share my screen now. So I only had a couple of things to share today as far as slides go, and then I just thought we'd give a conversation because here's the problem. Right now in the market, all the statistics are showing our slowdown still. We don't have updated statistics to show us what is actually happening in the market today because everything's delayed, right? All of our statistics come in later. And so I did want to just briefly share our statistics for February, just so that you can see them. So this is our days on market. Can you see this graph, Zach?
Yep, I can see it perfectly.
Okay, perfect. We are showing our days on market is up again. I'm going to go over that in just a minute on what we're seeing in real life. Our sold count is down. So the number of houses selling is barely down in February versus, and you can see this trend. It's pretty normal for it to start peaking back up February and March. So we're going to see that probably turn. And then we're going to go list to sell. This has gone up. So list to sell percentage, this is where what the home is selling for versus what it was listed for. So back in November, December, we were seeing it the lowest we've seen it in a very long time at 91% of list price. These are up to about 95%, which is a lot closer to list price. A couple of things come into play with that. Number one, we're seeing houses being listed more accurately for the market, as well as we are seeing a lot more buyers jump into the market, which creates quicker turnovers, and people aren't lowballing anymore. Homes aren't sitting for lots and lots of days. And so we aren't seeing them go quite as low. Median sold price went up. So that means this tends to follow pricing in general. So our pricing has gone up just a little bit that we're seeing in February versus, which is good to see it going up versus the down that we've seen the last few months. And then the original list price. So this is where we can see prices have kind of leveled off the last couple of months. We were seeing people listing at a more reasonable price. In fact, I would say we're actually seeing people listing low in this market right now. We're seeing a lot, and that's what's driving multiple offers. So I wanted to show this graph, which actually goes perfectly with the one that you just showed, your last one that you just showed about the differences between the recession and now. So this is just showing only our supply of housing. So we can see during this recession how many houses were available versus what we have available now. Our inventory is so low. And so it's just almost impossible for us to go into that type of market that we saw in 2007 through 2010, just because we don't have enough houses. People are willing to buy whatever's on the market for what they can get it for, because we just don't have the inventory that we need. Let me put this on present mode. That would be better, so you can see it better. All right, and so a couple things I just wanted to touch on. And again, I don't have the statistics to show this because they haven't come out yet, because this is just in the last 2 weeks. We're seeing multiple offers on properties. And the reason for this is we are seeing a lot of people listing low. So we're seeing homes being listed well under where they should be listed. Then we have people looking at them and getting really excited and then making offers, which is then going to drive our pricing up. I've been in multiple offer situations twice in the last 2 weeks with buyers, and they ended up with 5 offers on one, 10 offers on another. Both went over asking price. Both had an appraisal gap, meaning they were willing to pay over appraisal. Non-refundable earnest money is back in play. And so we're seeing a lot of these things that we saw the last couple of years come back into the market, which is frustrating for buyers, especially considering now their interest rate is double what it was when we were doing this last time. However, because of the shortage of houses, people are just willing to do it. Because we aren't seeing a lot of houses on the market, I looked at a statistic that said that the average rate for all of the loans in the United States is 3.8%. So the average person, 9 times out of 10, has a rate below 4% or right around 4%. Because if they didn't buy during that time, almost everybody refinanced. So now what we're seeing is, as prices have gone up and now rates are double, it's a lot harder for people to move. They just can't afford it because they're paying more for the house, but they're also doubling their interest rate. So we call it rate locked, where they're stuck in the house that they're in because they can't afford the monthly payment to get anything different. And so that's where our inventory is seriously lacking, is not only are people not willing to move to get the higher interest rate, they're not able to. And so as we continue to see interest rates high, we'll still see inventory low, and that's just going to really drive these multiple offer situations and kind of the frenzy for what's available. Even the homes that are selling. So now our buyers are in a situation, especially buyers that have been in the market for the last couple of months. And in a slow market, people take their time. So we have a lot of buyers that have taken their time. They've said, oh, the perfect thing will come available. But now the market shifted so fast that things are selling quickly. They're in multiple offer situations all of a sudden. And so even the homes that have been available for a long time are going to start moving a lot quicker, because buyers are now trained to, if I see a house I like, I make an offer on it, rather than I have time to wait and decide if I like that house. So we're going to see things moving quicker, just generally on the market, which is great news for sellers, because it has been a slow game for sellers. But for buyers, it is a little bit more frustrating. With that, I anticipate, and we're already seeing a lot of cancellations. We have buyers that got approved at a rate in January, and now they decide to put an offer on, but then they didn't know. Now interest rates are 6.5%. And so no longer can they actually afford it. They wrote the offer because they were pre-qualified, but they're not comfortable with the payment now that they're under contract. As well as, just as things move quicker, buyers have less time to really consider all of the things. And so they end up getting, they get into something that they actually don't want to be in. So then they back out. And so as we see this shift, especially over the next month, I would anticipate we're going to see a lot more cancellations, which we've seen that happen in every big shift that we've had over the last couple of years. We've seen a good month of strong cancellations, and then it seems to kind of level out and people understand the market better and get more comfortable with it. Any questions, Zach? I'm moving super quick. Sorry.
No, I love it. I mean, what do you think? What's a good, like, how can a buyer best prepare to get into this market right now? I mean, like, what kind of tips do you recommend if it's like, hey, like, we're maybe 2 to 3 months out of when we feel comfortable about it? What should we be doing right now to get ready for this next 2 to 3 months? What are some things that you would recommend for them to maybe consider?
Well, number one, I would make sure that you're qualified, and you're qualified for an amount that you like, and really get a good, not just what you're qualified for, but where your monthly payment hits that you're comfortable with. So if you want your monthly payment to be $2,500 a month, where does that land you as far as your purchase price? And just start getting comfortable with what homes are listed in that purchase price, and have an agent watching for you to see. We don't see what homes are selling for until they sell. So if we're in a multiple offer situation and we don't get the house, we won't know what it actually ended up selling for. In most cases, most of the time, the agent won't release the information until it's actually closed. So over the next couple of months, we're going to have a very vague understanding of what's happening as far as numbers go, because even as we're in these multiple offer situations, those statistics aren't being reported for another 30 days. So once you're ready in 30 days or 60 days, it's going to look very different as far as the statistics go than it does right now. But having an agent that's in the market that can kind of prepare you and just keep you in the loop as to what's happening is going to be helpful, because the numbers aren't going to tell us for a delayed amount of time.
That's awesome.
And so we can set up, and I have quite a few buyers on this right now. We call them listing alerts. So we just put in some criteria of what you're looking for and the price that you like, and you'll just receive the houses to your inbox. They'll just come to your inbox. That just helps you get an idea of, yeah, I would totally buy that house, or no, we need to increase our price range or change our location, so that when you're ready to go, you don't have this lag period of like figuring all of that out. You just already know what you want and where that's going to be, and you can just hit it hard.
See, I love that. I mean, I think that's such a good, I mean, just perfect advice, really, mainly because I don't always think people understand what the pricing of a home is going to look like, right? And then it's like, once they break it down, hey, your payment's going to be 2,000, 2,500, 3,000, 3,500. These are the homes you're looking in this range. Sometimes I get either sticker shock, where they're like, oh, I actually want a better house, and I'm willing to make a sacrifice for $200 more a month onto something that I really like, rather than going back. You know what I mean? And I think that's awesome advice.
Well, and I think especially for buyers that are in the market right now, make sure that you are staying up to date on interest rates. Make sure that you're checking in with your lender. And if you're an agent, make sure that you're checking in with the lenders of your clients, because those interest rates make a big impact. I mean, going from even a 6 to a 6.5, that prices people out. They can't afford what they were affording at the beginning. Not to mention, at this point, people that have been lagging and delaying purchasing, but looking in the market, now all of a sudden, homes that were listed for 400 that they were planning to spend 380 on or below and get their closing costs covered, now that home listed for 400 is actually going to go for 420 or 410. And so they're having to lower their expectations. So time is really important when you're looking at buying. If you're looking at getting in the market, and if we can get you prepared so that we can hit it hard, that will eliminate this lag time of now you're priced out of where we started because you waited 2 months to kind of figure out what you were doing. Because this market is just moving so quickly that the time just isn't on the buyer's side right now.
Yeah, I love it. Yeah, I mean, and I couldn't agree more. I just think, and typically, right? I mean, we've seen it in the past, but typically spring really picks up things. More people are a little bit done with the wind. I know the weather, and we were talking about that earlier. But schooling, trying to get out of the place that they're in. I mean, these are big things, the life decisions that people make around this time. And as I think we see rates start to trickle down, I mean, that statistics of list price is just incredible, right? I mean, to see that it's already going. I mean, that was really a month that we kind of had like a pretty advantageous market. I'm already back. So I think that that's important for people to consider as they're looking at this. Hey, like maybe it's time that we look at our time frame and say, what does this look like for us a month versus in 6 months from now? And I think that's awesome.
For sure. Well, and I wanted to show back to these charts. I wanted to show quickly, this one gave a really good depiction of how quickly the market changes. As you can see, I mean, this is the days on market. So we're at 60 right now, and you can see, you know, last year we were at 6 in February. And so just in a year, how quickly it's gone up. But even in this statistic, so January of 2020, we were at 39 days. And by May, we were down to 10. And so, I mean, that's how quickly this happens. We go from 60 to 10 or 20 or 15 in a matter of months. And if you're a buyer, I mean, it's not unlikely that you've been looking this whole time. You know what I mean? Like you started looking in February, and by March, I mean, homes are selling in half the time, and you're racing into those homes and trying to keep up with the market. And so that's where this has shifted so much faster than we thought it would. We're only in February. We anticipated this happening in April, May, but to see it already shifting, we're really gearing up for a very busy spring because all of our statistics point to this time of year, it only just gets busier. And then we should see it cool back down next fall. That is kind of, we're just anticipating not staying in this, you know, anomaly of a market that we saw during COVID, but seeing it, you know, swing in these normal swings up and down. But since we're already hitting, you know, this busier season in February, we just anticipate it to get worse until we start to see it slow down again, end of summer.
Yeah. And along those lines too, it's like if we see rates drop substantially end of summer and fall, that trend may continue.
True.
As we try to see
Yeah.
some of that happen.
Rates are going to be a huge impact. Even, I mean, if we see them drop in the spring, then we're just it's just gonna exponentially explode everything that's happening.
Yeah, I mean, it's like when they dropped the last time, it was just like a frenzy, right? And so I think being ready to go and to be in that spot is super important. For sure. Especially right now where the market, I think, is just, it's shifting so quickly back and forth all over the place that it's never probably been more important to be on top of what you're doing.
For sure. Yeah. And I mean, working with someone that's in the market, not that's just looking at the statistics, because like I said, those are delayed, but working with someone that's in the market, that's helping buyers and sellers right now, that's going to help just give you the best understanding. So reach out to somebody, ask all the questions, make sure you're prepared, because that's really the best thing you can do for yourself to get a good situation for you.
I love it.
Okay. Well, we went longer again. We could talk about this all day, I think.
It's good. It's all right. I mean, the good stuff, I like it. I mean, even if it's a little bit longer, it's good information that they could even like cycle through it, you know what I mean?
Sure. So. For sure. Well, if you guys have any questions, let me just check our chat. No chat. Okay. If you guys have any questions, please send us a message or comment. This will be on YouTube. We put it on YouTube if you want to see it. And so if you circle back to Instagram, that's where we hang out. So I am at the Megan Kuhn, and Zach is, what's your Instagram that you're going to start
posting? Just look for me, Zachary Hayes. I'm sure it'll be there somewhere. Next time I'll know what my thingy is, whatever username or
it's called a handle.
Yes, that too.
Zachary Hayes. Find him on Instagram.
That's where you'll find me.
You can send us a message that way. But thanks for being here. Thanks for watching.
Thanks, everyone. Have a good rest of your day and a good weekend.
Okay, bye.